Hello, YouTube. Welcome to another Wolf Catchers video. Hopefully, you guys had a good week so far. So, we're definitely gonna be getting geared and looking ready to see what's happened the past week and going into next week. All right. Also, hope you guys had a good Thanksgiving. Hopefully, you had some good food, great time with your families. So, let's hop into this one. All right. And don't forget, subscribe, like, comment, let us know what else you like to see on the channel. Give me any ideas, anything that you want to touch topics on or touch base on, just reach out, let us know what you'd like to see. And then also, this is not financial advice. I know I got to put that disclaimer in there all the time. So this is just for educational purposes. Definitely always do your own research. Definitely, how can I say it? Compare notes, go out there, consume as much information as you can. Obviously, make the ultimate decision that's correct for you, what's best for you. All right. So I'm happy you guys come here, check out the channel, but also be free. Feel free, watch other channels, read books, get as much information as you can. All right. So as we saw for last week, so that was the week of December 1st to the 5th. So we saw the rally is broadening, right? So we saw small cap stocks rising, and there is still some mixed economic data, right? Because we still got data that isn't going to come out because the blackout periods for the government shutdown, and then some stuff that has come out, it is kind of confusing a bit, right? So you're going to see later on we talk about some reports that came out, like unemployment numbers and things like that. But we did see during the Thanksgiving week, even though it was shortened, we saw a huge rally, right? For those couple of days, Dow Jones jumped more than 3%, S&P 500 went up 4%, and the Nasdaq went up more than 4%. So remember, leading into that, we had like a huge drop off across the market, the whole AI bubble speculation, and then it was just bad news across the board. The market was just looking for stuff to sell off and stuff to fall from, the Michael Burry saying stuff. And then it was just a concept of I think I mentioned before, selling but gets more selling. So, once the ball starts rolling, everyone starts feeling it, right? And then starts pressing sell, pressing sell, pressing sell. But then, if you panic sold, hopefully you didn't, you would have missed out on this rebound here, right? So pretty much almost everything that was sold off has now been pretty much gained back for the most part, right? So then we see here for this past week that we just went through, up almost over a quarter percent on the S&P 500. Nasdaq almost bought in almost 1%. So showing that there's still some momentum and some resiliency across those tech names that were sold off, right? And then sector performance, here's our winners and laggards of the past week. So we have communication services, energy and technology that rebounded nicely, and then they benefited from the broad rally. And again, something like technology was one of those sectors that were sold off really hard, had a nice rebound, and then and the inverse of that, we have the laggards, right? The utilities and healthcare. Remember, when tech and all of them were selling off, healthcare is rising up, but now it's healthcare's turn to give some of those gains back. But they're still up a great deal, but they definitely sold off a bit. Look at the chart, you can see it had a nice little red candle on that week. And then some of the top movers we had toward the upside of past week, we had MongoDB, and we had Microchip Technology and Dollar General. Each of those bought up a little over 20% each for the week. And then we could dive into the first one a bit. So MongoDB situation with them was they had a massive earnings beat, powerful growth in its cloud business, which is slowly starting to take over more, become more of a center for them. And they positioned themselves at the center of the AI data revolution. And the market is definitely rewarding them for them, right? So they're a database company, and someone needs to be able to store the data, right? And then we have companies that's going to specialize in AI data, which is going to be one of that type of companies, MongoDB. So they're one of those companies that I wouldn't say it's overlooked. It's pretty well known, I feel like, for the most part. But that's just another layer within the AI revolution, right? How we talk about the infrastructure and the layers of it, from chips, from foundation to cloud to platforms. There's all these different levers and levels within this space, right? That you could profit off of and position yourself. MongoDB just shows that, I guess, that confidence, and then that whole kind of disregard the whole AI bubble speak, where like there's real companies out here making real money, real profits, and benefiting for real off of this, right? And then we're gonna dive into microchip technology. There's someone that was overlooked for a long time because they don't really specialize in the AI semiconductors, but they still have chips that the market still demands. And their thing was, it was more so of a surprise beat when they showed the guidance. So for them, it's more so about the numbers they're forecasting for the future, and where they're showing that they're going to be making money at, and the sales and the backlog they have of customer orders, right? And then showing how they're stabilizing and how their specific sector is recovering, right? So for them to sum it up, it's surprised the market with, strong guidance, rising demand, and clear signs of a 2026 recovery. And then that just got an immediate reaction from investors, right? And then our last one here, Dollar General. So, you saw their stock jumped up 21% because of all the sales they're able to make. And then I feel like this dives deeper into that K-shaped recovery we talked about, right? That K-shaped economy, where we have the top, 10%, 1%, whatever you want to call them, but the higher earners in our economy that are pretty much doing the majority of the spending, right, for the rest of the economy, right? Because the mid tier and the lower consumer or lower earner isn't spending that much and is being propped up by those at the top. And then in the same breath, those at the top, they also are stepping down into where they are spending, right? They're not going to the high end retailers or the high end stores, stuff like that. A lot of them are stepping down to a Dollar General, are stepping down to a Walmart, things like that. So seeing that spike up in Dollar General, it's cool to see it in terms of like, yeah, they're making money, but it's also why they're making money, right? They're penetrating those six-figure households and things like that. So for Dollar General, it's they're beating expectations, they raise their guidance, they got improved operations, and they're capturing more value-seeking shoppers. So those are seeking value are the ones that are at the top. They have a high income and high income household earnings, right? But they themselves are still trying to seek value. And in Dollar General's, it's kind of like you think of Dollar General as like Walmart's too, right? Because a lot of places out here they have like these supermarket deserts and things like that, where you're most likely going to find a Dollar General versus finding a Walmart. So same way Walmart is pretty much everywhere you can think of, Dollar General has that same kind of footprint, that same kind of landscape where it's like it's easy to find a Dollar General, right? So, and they have some good deals when you go in there. They have a good program you sign up for. Same thing, a loyalty rewards program. So they have a way to build and bring in these customers and to have people buying and spending money with them and keeping you loyal too, right? So there is a company too that had a great numbers and then showing some insight onto the consumer. But again, for me, how I feel like it should be viewed as this K shape. I feel like a lot of people are riding on it, like, hey, things are still being spent, um, sales are still going up and all that. But I feel like it just keeps getting overlooked that the middle tier or middle income family and lower income family, they're not doing good. They're not doing okay. They're struggling and scraping by. And I feel like this is getting overlooked because everyone's just focusing on, the high end consumer is spending money, and it's just getting screwed, like misconstrued in my opinion. But I mean, I don't get paid to be, on CNBC and be the talking heads, but I feel like they do highlight it, but I just feel like it just keeps on getting overlooked. And yeah, hopefully, it stop being a K-shaped economy, and that spending and that wealth get more evenly distributed, and those wages and um, spending habits trickle down to the middle and the lower income tiers. But as we're going to see later on in this video, the rest of it in the next videos, that is going to be a big part into like liquidity, right? What the Fed does, where money goes, and we're going to know money's going to get pumped into the economy. It's just a matter of when, right? So, to touch on the macro highlights, we got core PCE that rose 2% year over year. So that's the slowest growth since 2021, which is indicating potential easing in inflationary pressures. So seeing the PCE grow slower, it still rose, but it's at a slower pace. So that's a good sign that it's slowing down in terms of how rapid these prices are going, right, for PCE. Then we have private payrolls. We saw a decline of 32,000 jobs, which is showing a cooling labor market. That's another thing where we get into the next statement. Jobless claims increased to 216,000. We're continuing claims on the rise, signaling the challenges for unemployment stability. So then when we see that with that one right there, we got claims increasing and then continuing claims. So that just means that there are more people who are filing for unemployment, and then the continuing claims are there are people who have already filed for unemployment that are still on unemployment. Because if you look into unemployment, um, some states have restrictions. So I think like the state of Florida has like you could be unemployed, you could collect unemployment for like 12 weeks, and there's a max for amount of money you could get per week, right? Some states have 24 weeks. So the thing is, we're not seeing these people stay on for 1 week, 2 week, and hop at, get back into the job market. Some of them are either maximizing the whole weeks allotted that they can, and that's also showing a sign too that they're not being able to find jobs, right? So that's not a good sign either. But again, I feel like depends on what number you look at, what you view, you could make a case or make an argument for like how is the economy doing. And also you gotta look at it from there's the investor mindset and then there's the everyday person mindset, right? The everyday person doesn't care or give a damn about what the stock market is doing, right? They're caring about how to survive, how to make it out here. And the investor, which is more so what we're geared to over here, what we're looking at, we do need the everyday person to be able to get in there, find a job, work, put money into the economy. Them working means people are spending money with that business, and it creates this cycle of money going out, right? So from the investor mindset, we do not want to see unemployment rise too high, right? And then also investors, what they're banking on, they want the Fed to cut rates. That's what they're all is going to bank on. Fed cut rates. They're looking at, okay, boom, rate cuts are in, quantitative easing gets put in because quantitative tightening is going to have started on the first. Investors want this to happen because we know what happens when money gets put into the economy, all the spending goes on. But we tend to always forget you have too much liquidity, too much money sloshing around, too many people with the ability to spend. It leads back to the cycle of high inflation, and then we go through that period of pain again, where it's like we gotta go back to increasing rates, making everything more expensive, and people are hurting again because people don't understand the cost. I feel like for when these things do happen, so it's all a matter of waiting it out, and you're gonna see it's just gonna repeat itself and repeat itself. It's the cycle that we're in, but it's about how both of these people position themselves, how the everyday person positions themselves to not suffer, right, and be at the wrath of what the economy does, and then how the investor doesn't suffer either, being at the wrath of what the Fed does, right? So you have to be able to play both sides of it, and whichever side you're on, or whatever boat you're in, you have to do what's best for you and yourself, right, to make sure that you come out on the end all right. So we got the ISM Services Index. This is just showing that it's at reading of 52.6. It's just showing how much the economy, for the most part, is expanding. So it's a slower pace than normal, which is again showing, a mixed signal out there. So the data this week just shows an economy is slowing in key areas. Inflation is cooling, which is good, But at the same time, the market is softening. So businesses are cutting back, unemployment claims are rising, and workers are staying unemployed longer. Back to what I was saying, people are putting more claims in for unemployment, and people have already put in their claims, they're staying unemployed for longer. So they basically are maxing out that, not mostly by choice, but probably because they just can't find a job, right? So when inflation falls and the labor market weakens, the Fed is more likely to consider cutting rates. But that also means the stock market could run into resistance if economy growth continues to cool. So investors should be watching these indicators closely because they hint at where monetary policy is heading next, and where this recent rally has some real strength behind it. Because again, we did rally, we had some good numbers and everything, but it's once this fog lifts and we get to see deeper into the numbers, see deeper into what's really going on, can this rally sustain, right? Because again, real life economy and the stock market, they're oftentimes are disconnected, right? The economy, the everyday person, that's reality. The market is always a forward looking mechanism. It's seeing stuff down the line. It's trying to figure out things 3 months, 6 months, a year, 2 years, 5 years from now, right? So then we got the Federal Reserve outlook. So right now, it's been jumping into the 90s too, but from when I wrote all of this up and set this all up, we're at an 87% probability when we go to the FedWatch tool. That's a good site to tap into, fedwatchtool.com. Let you know the probability for what the Fed's going to do in terms of rate cuts. Pretty easy chart to read. So right now, at the time of this recording, there's a 87% probability. And again, we mentioned before in the past, there are some split views at the Fed. Some people are saying, hey, we got to cut. Hey, we're not going to cut. We should keep rates where they're at. And then this is going to be key catalyst for us, for the markets, obviously. And that meeting is going to be on the 9th through the 10th. And I believe it's the 10th that he's actually going to call and announce and say, hey, this is what we're doing for cutting, if we're, staying at where we're at, right? And then getting back to touch on this mixed economic data, which is adding some level of uncertainty to what the decision may be. And then we still got the inflation pressure, right? Inflation is just that pesky animal that's just staying around and not getting rid of it, right? So some key economic themes to sum all this up over here: from durable goods that increased by 0.9%. We got OPEC, that's the oil people that's trying to help stabilize prices because they're cutting back on some output. We got the US dollar still weakening. It's been weakening for a while. And we got some geopolitical tensions that seem to be easing. So that could be taken with a grain of salt, maybe just because the media isn't reporting it enough. Because I don't know if you pay attention when you go on your social media feed, when you go online now, you don't see as much of it. But obviously, that's up to the individual if you're seeking for that information or what's also being pushed to you. So you're putting all that together in a bundle, and then you can say it's cautiously supportive backdrop, right, for markets. So you bundle all these things together, it looks like it's kind of primed for some good news for the market, right, to rise up a bit. So there's some things to look into, things to pay attention to, right? Some obviously way more than others, and some really don't. Then we got the technical outlook. So we got some major indices. We're approaching some levels of resistance. Um, for me, I just did the ETF equivalents of the indices. So I did the SPY, I did DIA for the Dow Jones, IWM for the Russell 2000, and the QQQ for Nasdaq. Nasdaq. When you look at all those ETFs, where for each of them, they're like a couple dollars away from hitting, like breaking past the all-time high, right? So again, we had that sell-off, and then now we're like a few dollars within range of hitting a new all-time high. Now I do apologize if y'all hear any rain in the back. I'm in my garage and it just started raining out of nowhere, so I apologize if you guys are able to hear it. So we got some upcoming events again. FOMC, that's the Fed meeting that's happening 9th to 10th. And then this is where the confusion kind of starts to tie into it, right? We got CPI, which is the Consumer Price Index, that's coming after the Fed meeting, right? So that's December 18th. Then we got PPI, which is Producer Price Index, which is going to be how wholesale pricing is happening, right? And that's going to be December 11th. So the Fed's going to be making its decision before getting these two key pieces of data, which heavily influence their decision for the most part, along with PCE that we get. So it is kind of one of those weird moments where they do cut, which is a high probability, right? They do cut. Markets should rally, but I feel like these two things right here could stop that rally. Or if they come out good, they come out cooler, like CPI comes out cooler than expected, like hey yo, and what is it? Inflation's going down, and all that stuff, and the PPI looks good, all those numbers look good. It could increase the rally, right? And then you're just gonna be running on vibes all the way through. They have the Santa Claus rally. People are just gonna ride it all the way through the end of the year. And December, historically, it's a positive month, and then that may come to fruition. But I feel like it's good to be cautiously, optimistic in all situations, right? So we bake in the rate cut, right? Get that, boom, that's cool. I would say expect CPI to probably, yeah, be cooler than expected, right? And then PPI probably, but I wouldn't put too much stock into like, just don't get too over your, head over heels about this. Still be in position. That's the biggest thing. Be in position. You should already be in position. You should already be in quality names. You should have already been in the names at the price points you wanted to, this and that. And then I'm speaking from an investor standpoint. If you're trading, all this matters in terms of where you got in, where you're going to get out, what percentage you want to get on your rate of return, all that stuff. But long-term investing, I look at this as, yo, we was already in good positions. Like, stuff fell to like the 400-day SMA, boom, you bought some stuff there. Some stuff fell the 100-day SMA, boom, you bought some stuff there. So like when we go into the next slide, you're gonna see some stuff that was probably at some good prices, opportunities for you that bought then. And then now that's what I consider really riding the wave. You're already in good position. You're not chasing these things. These things matter, yes, but over the grand scheme, I got into X, Y, and Z 6 months ago. I'm good. I got into this. That's what it is. But if you're trading, then I could see where, oh my gosh, this means so much because it is going to affect your portfolio. It is going to make a swing. If you got an option trade that's expiring next week or the week after, yeah, this will destroy your portfolio if it doesn't go your way. If you got something that's expiring next month, yeah, it might destroy your portfolio. But if you had bought your option trades, even option trades, right? Buy those things out a year, 2 years in advance. Yeah, it's gonna cost you more upfront money, but you can weather storms like this. And when you're buying those options too, don't buy them when the market's rallying. Buy it Liberation Day. You should have bought some options that week or a week after. You should have bought some options because everything fell down towards a 100-day or 200-day moving average, or everything was damn near a 52-week low, stuff like that. That's when you should have put the money in, bought those options, and then you like, hey, I'm buying this. That's going to expire in the end of 2026 or early 2027. That's how you play the game. That's how you do it. Same thing for when you're buying individual stocks or buying the index, whatever it is. If you are going to put money into it, you're not going to dollar cost average. You want to wait it out and you want to time your entries. Buy when everyone's afraid, when things are running red and bleeding. So watch list themes you got coming up. You got the AI cloud. So that's a good thing to pay attention to. As we mentioned, we got MongoDB, a microchip technology company that was doing their thing. And then it just reinforcing the AI trade. As we can see, we also saw too, if y'all paid attention, Google kind of like overtook NVIDIA as the darling now. So that's why I go back to, if you ever read my articles, or I got to make a video about the portfolio to explain to y'all how I have like my Sun portfolio set up. Because the portfolio, I feel like, not trying to say it's like going to be the greatest thing ever, but I love the way I have it structured because SMH, which is the Van X Semiconductor ETF, I have that as a big part of my portfolio for my son, right? The reason why I have it in there like that is because I don't know who's going to win the AI race, right? I don't know who's going to win the semiconductor race, but I want to make sure I have bits and pieces of the winners. Like they're going to be winners, but who's going to hold the gold medal at the end? I don't have no clue. Same with technology. I don't know who's going to hold the medal at the end of the day in terms of being the best tech company ever. But all y'all are fighting for number one, and all y'all at the top. I want a piece of each one of y'all. So something like what happened with Google surpassing NVIDIA based on, because they got TPUs now and all this, everything, CPU, GPU, TPU, XPU, all these PU stuff, it's going to be confusing for you. And if you don't have the time to sit down and do the research for it and all that, just tie your money to the best winners, right? Or to the best probability winners for you. So SMH gives me and gives my family exposure to the semiconductors, right? But also, I got a position separately in Google. We also separately positioned in Amazon, separately positioned in Microsoft. We got positions in something like FNILX, which is large cap growth, right? So you have your money tied to these things in a certain way where one of y'all win, some of y'all win, doesn't matter. We all winning. That's what matters at the end of the day. So the AI cloud theme is still a strong theme. And again, the best way I feel like to attack that, get yourself to SMH, get yourself to Qs, QQQ, and then you can apply the satellite theory, get you the one or two top names in there, and do that up, and then you're straight like that. So then we're also going to go into another theme, consumer strength. When we talked about Dollar General, and then we talked about ULTA. ULTA is one of those names where if you pay attention to their chart, they always had this period of time where they're selling off. People aren't messing with them. They all a favor. Then out of nowhere, they pop back up. ULTA is one of those companies I feel like is a sleeper. I feel like it gets very overlooked. But me personally, I've gone into ULTA before with my wife or female family members to go in there to look for stuff, and very rarely I'll go into ULTA and there's not people in there buying. ULTA has, I feel like, great customer service. I feel like they have great product lines. I feel like things are priced at a point where I never look at makeup as like, oh, it shouldn't be that price. I look at it as like, yeah, it should be that price because so many people are spending it. I look at makeup as it's supposed to be expensive, right? Very rarely do I hear consumers or buyers of makeup. I feel like, at least personally, try to look for a great deal or look for something super cheap. No, if you want a quality product, I feel like people understand that there's a quality price that comes with it. And I feel like ULTA does a great job of doing that. And then when you look at the chart, ULTA had two periods, right, where they fell to the 400-day SMA on the weekly chart. And you see they fall and touch that line, and then after that, they rock it up. And then you go to the daily, they spent pretty much, I think, the past 2 months at the 100-day SMA, right? Big behind, long consolidation, right? Just sessions after sessions after sessions in the same range. Those are accumulation zones, right? I think one of the videos we posted, we talked about the four phases of buying, right? The four zones of buying. That's when you want to buy. You want to buy when you have that long range, like accumulation. That's all you see. Yeah, you're not gonna get a return on it right away that day, maybe that week, but you're loading up your base. You're buying out your foundation in that moment for when it does rise up. And if it falls down a leg, hey, take your lick. You fell down a leg, and then cool, we're gonna reload again. But that's why you buy in tranches. That's why if you have a certain amount, hey, I have $1,000 I want to put in this position, you don't spend all $1,000 right there. You can probably take 25%. I'm willing to load up the base here. If it falls to another part, here's another 25%. Another 25%. My last 25% is for this load the boat price where everything's going to hell. I'm putting my last 25% right here. And then that's how you play the game. So Ultra's another one that had a lot of period times of selling off, and then they have moments where they run up crazy. You just have to pay attention to those type of companies, right? And then we got industrials, we got FANUY. I forgot to write out the whole name for them. They're a Japanese company that specializes in automation. So the robotics, right? So those robots you see in the warehouse are usually the yellow ones. So they're real big in that. And then you got SAIA, which is one of those trucking companies. You've seen it before on the road. It's red, a huge red truck. So they have shown some good signs in the automation industry and then for industrial market, right? So showing some interest. SAIA, when I look at this chart, it's still undervalued from what I last seen. It's still trading. I feel like it's at a 253-day SMA, and all the other moving averages, like the 100, 200, 50, 72, it's still trading underneath all those. So it's still opportunity for it, obviously, to run up some more, because I look at these opportunities as if it's trading below major key moving averages, those are opportunities to probably get into the company. Obviously, understand why it's there, but opportunities to get into it and then let it run up past those moving averages. Because once it goes above those moving averages, now you're looking at all those things that support to hold it up, right? As long as it's still trending above it, but it has to surpass those to get into an uptrend, right? But yeah, I feel like those are, I don't know about FANUY. That's more so just to show you what's going on in the space, because I don't believe in foreign investments for the most part. But something like SAIA, I could see why it's showing some good highlight for the industrial sector. We got healthcare. Remember how we mentioned there's a pullback in there. So we got some names that dropped back. But overall, those names have only run up so much, like Eli Lilly, right? But it's just showing there may be some opportunities there. I definitely would say, look into the sector, XLV, crack open the ETF, see what names are in there, quality names. Again, I always say top two, but you can look at the top five, see what you can find in there after you crack it open. Then we got media. So media, we had something big happen this past week. We had the Warner Brothers Discovery and Netflix had a deal. So Netflix bought Warner Brothers Discovery, so they gain access to, I think it's all their DC content. I know stuff like Harry Potter and things like that nature have been accessed. So that's pretty good for Netflix at least. And then whenever we see acquisitions go down like this, a lot of people kind of don't understand how it works. So usually the company that is doing the acquiring, the company that's buying, is the company that's the stock price that's going to go down. The company that's being acquired, that stock price is usually going up. So that's the best way to look at it. A lot of times people look at it and be like, "Oh, how come the stock's not going how they thought it would be?" This is good news for Netflix. It is good news, but also they're doing the spending to acquire the company, right? So another thing we're gonna keep watching, keep paying attention to. Um, just continue watching the analysis of these themes and then the insights for them, and then staying informed. That's the biggest thing. I'm not saying be a nerd or you'll need to subscribe to emails and have things flood in your inbox, but just stay on top of what's in your portfolio, what can affect it, what's in the news in terms of what you got going on, right? If you're someone, like I said, you're invested and you care about what's going on in your portfolio for the most part, for the day to day, the week to week, month to month. And it's not to have you be locked in like, oh my gosh, I'm over here always worrying or wondering what's going on in my portfolio. It's just for you to understand what's going on. You want to be able to log into your portfolio on a Wednesday and look, and if it's down a couple thousand, down 20%, at least you know why it's going on. You got to understand where your money's at and also what's going on in the market, right? From a macro perspective, things like that. You don't ever want to log in and then see everything red, stuff going to hell, and then you don't know what's going on. That just highlights that you probably haven't done enough research. You don't know what your money's in, where your money's invested at. So just always keep that top of mind, right? Know what you're invested in, why you're buying it. Buy at quality prices, quality names, have conviction behind your buys, and it's going to take you far. You stay locked in with it. So, again, do apologize for the rain and everything. I got up and walked away from where I was sitting at before. Hopefully, you didn't hear too much of it. Just want to say again, thank you so much, for tapping in with us. Again, email's right there, thewealthcatcher@yahoo.com. If you're going to send me an email, I'll try my best to look at it and keep on top of it. Website is thewealthcatchers.com. I did put some articles up there recently today. I did put up something about the Fed and liquidity, and then the upcoming Fed cut, right? So again, the link should be in the channel for the page, and there should be a link in the description at the bottom. If you want to tap in, look at that again. Thank you so much for visiting. Like, comment, subscribe. I'm gonna see you guys in the next one. All right, peace.